me post the budget, a very important global market investor, legendary investor who many very closely follow. Dr. Marc Faber, author of the Gloom, Boom, Doom report, is right here with me, live from Singapore. Dr. Faber, great to have you on the show. Thanks very much for taking out the time. Let me start off with three comments that you made about India in the recent times. You said governments must not spend much as it's negative for a free market. You said that lower rates helping growth is a bit questionable, and that slow pace of reforms in India have been disappointing. In lieu of the opinion that you've carried on India, what did you make of the budget that came out yesterday? Did it reassure you?
First of all, I don't think that the budget is all that important. The important thing is that it's rather coming down than going up. That's a step in the right direction. But if you look at the composition of the budget, basically subsidies are going up, and the government salaries are going up, and capital spending is actually quite anemic, disappointing. So if anything, then I would say the budget is neutral to slightly positive.
Okay, what were the positive aspects in the budget? Do you think that maintaining the fiscal deficit target at 3.5% has reassured investors that the government will be managing its finances well?
Well, one of the problems in India is that actually the largest expenditure are interest payments on the debt.
That's true.
In other countries, that is not the case. And that has to be brought down somehow, either through borrowing less as a percent of the economy or through sharply lower interest rates. But sharply lower interest rates are not in the cards simply because that would weaken the rupee very considerably. So I think the budget is kind of neutral. Now the stock market has reacted mildly positive, but from an oversold level.
So that this is just a technical rebound in your view. Many in India believe that because of what the government has announced in terms of fiscal measures and keeping the fiscal target at 3.5 unchanged for next year, that perhaps we might be seeing more rate cuts in India. You're saying that's not really the answer to growth.
I think they can still cut rates. But as I said, if they do cut rates aggressively, the rupee will go down.
So beyond 70?
Yes, possibly. Yeah, it's between 70 and 75. I don't know. It also depends on the position of other currencies in the world and whether the dollar is strong or weak. But in general, as you know, the rupee has over the long term been a weak currency. And I think the best for India would be to have a strong currency, not a weak currency.
All right, fair enough. The opinion over there is divided. Many believe that to be competitive in the export market, a weaker currency would benefit India.
No. If you look at countries that are very competitive in terms of their exports around the world, until recently Japan, Switzerland, Germany, all these countries had strong currencies. Weak currencies is a subsidy to the corporate sector, and strong currencies force the corporate sector to become productive and to produce more at lower costs. That is what India should pursue.
All right. The other focus is growth, right? It's the focus of the government, it's the focus of the RBI, and that's where the efforts are being drawn. You have stated that if India gets its act together, 6% growth for the next 10 years is possible, but the government is more ambitious. They're talking about 7.5%, 8% growth for India. Do you think that in a low global growth environment that India can sustain growth at 7.5%, 8%?
That I very much doubt. But miracles do happen in the world. But in general, I think that in a world that, in my view, will not grow for the next 5-10 years, or it may grow by very little and then have recessions again and crises again, I think to grow at over 7% per annum is very ambitious indeed.
Yeah, part of the miracle is, of course, trying to get in revenues through taxes. I just wanted to ask you, you said that India is looking relatively cheaper than it was 6 months back. Is this a good time? Would you be buying into India?
Well, if you look back at the peak of the market in US dollar terms, which was, I think, in January 2008, we are down 37%, the market index. And the peak last year in dollar terms was in March, and we're also down 30%. In rupee terms, we are down 23%. So we are getting into a buying range.
Almost a bear market zone.
Well, I mean, depending on how you define a bear market.
Technically, just 20% fall from the peak.
Basically, we've had a big correction. I think we may still go lower somewhat. But long-term investors, I think around this level, will be okay.
Will be okay. So, you know, India...
Well, I hope so. I hope so. The big question is whether in the world, after the colossal asset inflation we had starting in the early 1980s, we had a bull market in bonds, and yields have fallen much more than had been expected at the time. Stocks have been in bull markets until last year, or even some people will say they are still in a bull market today. Basically, property prices have gone up. Everything has gone up that concerns assets. It is conceivable that the way consumer price inflation in the 70s went into a disinflationary period, that we have in the world a period during which asset prices come down. You see, for instance, here in Singapore, high-end property prices are already down more than 20% from the peak.
Yes, rentals are down as well.
Yes, and in Hong Kong, many of these prices are also down. So I think that we could be in a period during which assets simply don't perform well because they're already very high.
So do you believe that at this point in time the risk reward is favorable because asset prices have come off? So, you know, India also perhaps is in that zone where as a market, you know, it's a favorable, favorably positioned right now?
Yes. I mean, I would say probably in emerging economies, we're at least halfway through the correction. You understand? In the US, the correction hasn't really started except in some sectors of the market. So from a longer term perspective, maybe investors should consider starting to buy some Indian shares. But I don't think there's a great rush to do so.
Okay, this is my last question on India, and then we talk about the globe at large, because that's one perspective people want from you. IT and pharma, you like that space in the Indian market?
Yes, I think these are two industries where India is very competitive, and I think there is a lot of potential. But you obviously need a careful analysis because not every company is the same. So some companies will do well and others will not do so well.
Have you bought shares in the last 2 months?
What? Well, the thing is, people laughed before or last year at a diversified portfolio. But in January, February of this year, a diversified portfolio has performed very well because you had some precious metals and precious metal companies, and you had treasury bonds in the US, and those have performed very well. So, say the portfolios I look after, they haven't gone down in value.
Okay. Because you were diversified.
Yes, exactly. Last year, someone may argue, well, you didn't do so well because you were not in stocks. That depends what kind of stocks you held. In the US, the average stock is down 25% from its high. But the indices were driven by the so-called FANG stocks, Facebook, Amazon, Netflix, Google's, and maybe another 20 shares that kept the index up, but below the surface of the indices, the market was already weak. So I think that last year, actually, most people lost money, and some big hedge funds lost actually a lot of money. So it depended already last year very much what kind of shares you held. If you held Indian shares in US dollars, you also down almost 30%.
Yeah,
you understand? And if you held Chinese shares and you bought them at the wrong time, you're down 50, 60%.
On average, people are sitting more on losses right now than gains.
Yes, that's
But
right.
do you think that can change? Because you've seen such a prolonged period of at least extending out to 6 months of volatility and asset price corrections.
Yes, we can have, the markets are a bit oversold and there could be a rebound. But in general, I think we need more pain and we need lower prices to really make them attractive. But as I said, I own some shares. I would prefer to see the markets down another 20-30% to provide some bargains.
Okay, and some of those bargains I'm assuming will come in India. Huh?
Some of them, hopefully, yes.
Okay. The question then that comes to my mind is that that means the timing of the rate hike was all wrong?
I think...
Because do you sense that the US, if you're talking of a no-growth environment, because
Yes.
last time, Dr. Faber, when rates went up in the US, which was in 2004, growth was at 4.5%.
Yes. The thing is, in 2004, they started to lift the Fed fund rate from 1% to 5.25% in August 2006. They cut the rates after September 2007 again to 0% essentially in December 2008.
In 15 months.
So in December 2008 to December 2015, we had a period of essentially zero interest rates. The economy in the US was actually expanding at quite a healthy rate in 2010, 2011. That is when the Fed should have increased rates. But now they kept rates at this artificially low interest rates until December 2015, 3 months ago. And my view is, Miss Yellen, she will have a huge portrait in the Museum of Great Financial Errors.
So they got the timing wrong.
Increased rates exactly at the time the global economy is entering a global recession.
So do you think that they will have to rework completely that that another rate hike is just going to be such a hard decision?
In my view, there won't be more rate hikes in the US. They'll probably cut rates, and it will be followed probably also by negative interest rates, whereby we have to consider it's an election year. So maybe they have some, let's say, reluctance to cut rates to below zero in an election year, because it could be interpreted as a political kind of maneuver. But anyway, my view is before the end of this year we have QE4.
QE4, that's a big headline coming in. Dr. Faber saying that we're having QE4. But that's the problem, Dr. Faber, because in 2011, 2012, when they tried to withdraw QE, right, the markets panicked.
Yes.
And so they came with another round of QE.
Yes.
The point is, if this medicine doesn't work for the markets, and if it's calling for the same reaction again and again, mind you, when QE ended the last round, it ended in October of 2013, October of 2014, and by August 2015, we've already started seeing the tremors in the world market.
Yes, correct. But I'd like to point out, it is a great fallacy by central bankers to believe that by pushing up asset prices, you can create sustainable growth. It's a greatest fallacy. And the BIS, the Bank of International Settlement, they made a study about all the periods of inflation and deflation for the last 200 years. And they came out with the conclusion, having studied all these periods of inflation and deflation in the world for 200 years, that there is very little relationship between consumer prices going up or consumer prices going down and growth. But they came to the conclusion that when asset prices come down sharply, especially in a system that is indebted that this causes very serious recessions, depressions.
And that's
That is
what
the
we are staring
conclusion.
at?
And if the Fed and other central banks believe they can push up asset prices forever, they're dreaming.
But do you think that's what we are staring at right now, a recession in 2016? And if that's the case, then if you're looking at even some rebound rallies, those will fizzle out because the markets really need growth. They need corporate earnings to move higher from here. And I'm talking about essentially the equity market.
Well, that's what I'm telling you. I think we're not going to go much higher. And I just explained to you that, in my view, the great asset inflation that we had 1982 last year is coming to an end.
So is it all gloom and doom just as yet, or gloom but not doom as yet?
Most people, they have no assets. They have no money. So what does it do to them if the price of a Picasso painting goes up or down? They don't own a Picasso painting. They don't own high-end properties in London, Singapore, Hong Kong, Mumbai, Manhattan and so forth. So it doesn't touch their lives. The notion of asset prices going up being good is kind of a brainwashing economic theory that benefits people that already have substantial assets. Mm-hmm. Ordinary people, they don't benefit from rising asset prices. In fact, they are being hurt. Look, when I started to work on Wall Street, I could buy the Dow Jones at less than 800. Mm-hmm. It had a dividend yield of 6%. Bonds were yielding 6%. So the compounding impact was huge. And real estate was inexpensive. Collectibles were inexpensive. Now, a young guy, he starts working. Please explain to me how he's going to save.
That's true.
Hey, he has to rent apartments at very high rents. If he wants to buy one, he has to pay a very high price. And if he wants to have his money on deposit, in Europe there are $8 trillion worth of bonds that have a negative yield. So you deposit your money, you give it to the government, and the government gives you back less. How are you going to save?
Dr. Faber, you sound very worried about the current scenario. But as an investor, even in a gloom-doom outlook, one always looks for opportunities. Where is it that you're spotting an opportunity? We didn't talk about China.
Well, I told you, I think there may be a rebound in oil. And the sector that I think is the most attractive are basically precious metals. And in this environment of money printing, I think precious metals are part of a portfolio. And the precious metal stocks, the mining companies, they've declined something like 90% from the peak. Mm-hmm. They have now doubled from the lows. But you understand, you go down from 100 to 10 and you go to 20, you can still go to 30, 40. So I think we are in the initial stages of a bull market for mining companies. And then in terms of countries, some countries' stock markets are quite inexpensive, like Russia. They have some problems, but I believe this year the sanctions of Western Europe towards Russia will come off, and that things will actually stabilize in the Russian economy. Mm-hmm. So I'm not that bearish about Russian assets. And then, as I told you, relatively speaking, I think emerging economies are okay. Similar to India, I think Vietnam is a more attractive country because there's a lot of foreign direct investments pouring into Vietnam from the US and also politically also from Japan, South Korea, Taiwan and China. And the boom country right now is Cambodia. There everybody's pouring in money because they don't want Cambodia to essentially fall into the Chinese camp. So it's a real boom town.
Okay, I have two questions before we wrap up.
Yes.
One, are you buying gold?
I always buy gold.
Every dip?
Not every day, but every month.
No, every dip I was saying. Every fall you buy gold?
Yeah, I buy...
every correction?
I always buy. I have a standing order to buy some gold every month. And then when gold becomes, say, in my view, it may be wrong view, but in my view, when it becomes cheap, then I add to the overall position.
And is there a target that you have on gold from here? Because it hasn't quite moved up. You're saying other asset classes are not going to move up. Is gold going to move up?
In the late 70s, there were some forecasters. They said gold will go to the sky, to heaven. And they were right, because the gold bull market died and it collapsed. So I don't know, but in general, if you look at the performance of gold, in other currencies than the US dollar, it's been actually quite good.
Okay.
So I believe actually that the US dollar, I don't see anything good about the US dollar personally,
Okay.
but maybe other people see something
Yeah,
good.
that's true.
They can see Mr. Trump. So,
Perhaps.
but in general, I think people should own some gold, not too much and not on leverage, but they should own some gold. And as I said, they should own some real estate. I think in India, there's still lots of real estate opportunities.
Okay.
Because if you look at Europe, most middle-class families in Europe,
Sure.
they have weekend homes
Yeah.
or summer homes. So they work in Germany, then they spend the winter in Spain or retire in Spain or in Turkey or in North Africa and so forth.
Sure.
I think in India, you will have more and more people that work in a unpleasant city like Mumbai, and then they go away for their holidays to a beach resort.
Mumbai has its pleasant moments too,
Yes.
Dr. Faber. I welcome you there.
Every city in the world has a pleasant moment, I suppose.
Okay, just final question, because we didn't touch upon China.
Yes.
So do you think the China worry can spook the markets again? They're saying we are easing, we are doing what we are doing with our economy, we are changing the economic model. Give us time, transitions are painful.
I think the economy is still slowing down and is worse than what the statistics show. The problem with any forecast is that markets are no longer free markets, but they're manipulated by governments with their fiscal and monetary interventions. To forecast manipulated markets is very difficult. And the Chinese, they can flood the system with liquidity, then the currency will go down.
Yeah.
But the stock market may go up, who knows, if they really flood. And so the same applies in the US. They can launch QE4 and flood the market with liquidity, and then maybe assets go up, but the dollar tumbles. So lots of things can happen.
But your summary on China?
My summary
you'll
on
avoid
China
it?
is the period of very rapid growth of 8 to 12% per annum that we had between 2000 and 2007. Forget it. Forget it. It may grow at, say, 4 5%.
Sure.
But my view is we have a colossal credit bubble. By the way, the credit position in India is not particularly good either.
Yes.
But in China, we have a colossal credit bubble, and that has to be deflated first.
All right, Dr. Faber, thanks very much for taking
My
out the
pleasure.
time to speak with us.
Okay.
Really appreciate your views.
My pleasure.
You heard it from the man himself, Dr. Faber, talking about the globe, worried about global growth at this point in time. He's, of course, quite neutral to positive about the about his Indian outlook and about the Indian budget, but overall, his concerns are many. Of course, his top trade is buy gold. With that, we wrap up this edition of the FII View at Singapore. Thanks very much for watching the show.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.